Do you think the 30-second opening range comes into play? The 30-second opening range in particular, no. But let me say this, any opening range can work. I think the opening range is like, it's like a myth. Okay? Opening range. 30-second opening range. Well, guess what, guys? Imagine if we had a 30-second bar chart and we opened and we went down some, and then we went up some, and then we went back down a little bit, and we closed. This strategy is now a buy limit order, above that 30-second bar, and a sell limit order below, right? If you are trading I think the main origin of that, which is a much longer time frame, let's call it the initial balance, which is historically the first hour of trade, or as market profile people consider it, the first two TPO periods. Well, guess what? Then you've got a 1 30-minute bar and another 30-minute bar. And guess what? That high of that first hour and that low of that first hour, that's your initial balance. And so there's folks who will buy breakouts above that, sell if it fails when it tries to break out, things like that, right? And I'm not saying you can't do it or whatnot, but like, opening ranges seem to be in vogue right now. And I just want to let everyone know that, because I think people genuinely think there's something about like a certain period opening range. And what I just showed you is, well, if that was your bar type, all you're doing is waiting for one bar to print. And then you're saying, well, if it goes above or below it, I'm going to go with that. And a lot of times off the open, there is some momentum. A lot of times off the open, there's back and forth whipsawing. So, but the main thing is, like, if I put together a trade idea, it's going to have multiple higher time frames feeding information into this idea. Okay. And from there, I'm going to go to my trading time frame, and I'm going to wait for essentially like a setup right there. And from there, I'm going to look at momentum and order flow and whatnot. And I'm going to essentially time the trade, right? And trigger into it. That is very, very, very different than saying, well, I trade XYZ period opening range. Okay. It's just, it couldn't be further apart. But so anyways, that's my thoughts in general on, opening range stuff. I know there's traders who use it. From time to time, I'll keep the initial balance. I only use the first half hour. That's kind of how I was taught to do it. But there's nothing magic about those things. There's nothing magic that you could put on your charts that tells you whether the market is doing more of this or whether the market is doing more of that, right? Or more of that. And whether or not you're looking at the first, XYZ period or whatever, sometimes the market does this, right? And folks will tell you can just fade the edges of it. And sometimes the market does this, and folks will tell you can buy the breakout of it. The problem is the in-between stuff, right? So for example, like, because I consider an opening range to be, as I described, compared to my NADRO methodology, I consider opening range to be not robust in terms of a strategy, right? It's just like you could teach it to a kindergartner, you know? And there's something to be said for simplicity. But I think ultimately, if I'm going to condense down or put together a trade idea like I do with NADRO, and it's going to have multiple higher time frame views, and only that might get me interested if there's enough confluence and a directional bias that I like, and a clear line in the sand and some recent rejections. Fine, I have an idea, right? And then you kind of continue stepping down that top down approach all the way to like the here and now order flow, who's being aggressive, who's buying, who's selling, what's going on, right? That type of putting together all those timeframes and all those tools, I believe, is more likely to give me more of a robust edge, more of an edge that holds up more frequently, more of an edge that where I can truly see risk reward in the in a market, rather than just this like simple singular variable thing. I don't think it's going to be as robust. I think that my good lines in the sand, as you guys see day after day after day with the DMI, obviously not every day, but a lot of days, those things are pretty darn good, right? So I think that kind of proves that robustness of picking spots and being able to see the risk reward landscape and what levels are most important versus an opening range. I think you're more likely to get these in between scenarios, such as the following. It looks like a failure, right? It looks like one of these. And then it does this, right? Or it looks like a nice breakout that's holding and you get long. And then it does one of these, right? I think that less robust, less holistic views of markets lead to more false positives, right? And overall just less edge, right? I think my edge comes from, you know, one phrase that I've said in the past based on it, it's like a profiling term, really is what it's connecting to. A value term is my edge comes from the edges, right? My edge comes from the edges of value, essentially, right? My edge also comes from layers of edge upon layers of edge. That's really where my edge comes from too. Don't tell me my edge comes from psychology, right? Of course, you have to be a functioning thinker and be able to regulate your emotions and see things objectively, right? That goes without saying. But that's not where your edge comes from, guys. Edge also doesn't come from risk management. Risk management can make or break whether you're able to actualize an edge, just like psychology can. But the edge has to come from a methodology for buying and selling, of picking trade locations, of choosing stop locations, right? And managing winners and cutting losers.